Yes, I'm the last speaker of the day, and just wanted to introduce myself, Aris, Christodoulou from Desjardins. I'm one of three wholesalers supporting IDC in Ontario. Quick background on Desjardins. Strong footprint in Canada, been around for 124 years now, and managing par for about 75. And we're going to talk a little bit about our 5-pay, and a new concept we introduced, and we've already seen some strong flows with the new concept. But anyhow, what's probably important to note about Desjardins, other than we're a large company and we have lots of assets under management, is our organizational structure. And we're the largest financial cooperative in North America. And most people ask me, what's a financial cooperative? And essentially, we're owned by our clients and members. So we generally take a longer view on the market. We're not publicly traded. You can't find our stock on the Toronto Stock Exchange. And why that's important for clients is, again, that longer view on the market. We're not driven by short-term profitability and those types of factors. So that will be reflected in, the stability and kind of long-term performance with respect to our par and in-force blocks as well. So, getting into our product lineup and kind of where this solution might fit your client base. We don't only have a 5-pay, of course. We have both wealth, which is early cash value and estate product, 10-pay, 20-pay, pay 100. So we've got everything you need, but we launched the first and the only 5-pay guaranteed contractual contract in the marketplace. Questions I get often from advisors are, where does it fit? Where should I look at 5-pay? Maybe compared to 10-pay. So we'll dig in a little deeper on the product side and share some details with you. One of the more common ones I get is also, what's your DSIR? So current dividend scale interest rate at Desjardins is 6.3, one of the highest in the marketplace, which is great. Of course, over the long term, stability is more important than current dividend scale, but it definitely helps to be on the higher end of the spectrum with regards to dividend scale interest rates. And that was an increase from 6.25 last year. So definitely moving in the right direction. And we feel we can sustain and continue to increase that over the long term with the asset allocation we have. And I'll get a little more into, who our manager is. So Desjardins Global Asset Management runs our par fund. Our total par assets are close to $2 billion. And the team also manages a total of $107 billion. So we've got a lot of specialized groups, investment professionals that work in various sectors, asset classes, and also an asset allocation team that really designs our par asset allocation based on the current outlook to, ensure we're providing performance stability and good guarantees for our clients. So here's a bit of background on our par asset mix. Lots of numbers on the screen. This is our current new fund. As I mentioned, we do access our in-force par block for investment opportunities, which is close to $2 billion. What you'll note here that may vary compared to maybe some other par funds you're more familiar with is we have a larger allocation to non-fixed income in our par fund. So about 41% of the fund is non-fixed income. Now, some people think that's all common shares, which would obviously mean it, could be more volatile, but not the case. We diversify that, 41% across various asset classes. Common shares represent about 11%. But where we differ is really, you'll see here on the screen, our infrastructure holdings. And for those of you who aren't familiar with infrastructure, it represents 9% of our fund. And these are long-term projects, things like toll roads, railways, cash flowing businesses that really have strong barriers to entry, strong pricing power, and they're long-term projects. So it fits in very well with a par investment strategy, which is obviously a long-term approach. And you'll also note last year, our par fund returned 8%, so they're just over 8% net of fees, which was a pretty strong number for us. So just getting into 5-pay a little more, okay, what's unique about the product is obviously the schedule. And one of the questions I get especially when we launch 5Pay, is, what age, what amounts should I be looking at when I'm thinking about your 5Pay? And my view on where this solution could fit best within your client base is really, outside of focusing on projections and letting projections sort of dictate the client's premium schedule. Think about the clients who would benefit from a guaranteed, limited pay schedule and with zero risk of a sixth payment. So it's those clients who aren't comfortable with, long-term premium obligations, possibly volatility, dividend scales changing, having to put in more money. And of course, clients who have, cash on hand. They're in a good, comfortable, capital position, able to look at a shorter duration that still meets their insurance needs. So our strategy is quite simple with 5Pay. There's no risk of a sixth payment, regardless of dividend scale. There's no ADO rules to explain, or that vary. Death benefit will never go down. So it's really peace of mind type solution for obviously clients who are more liquid, perhaps have an investment portfolio, maybe some money in fixed income, unaware of the tax opportunity they can access through investing in whole life, perhaps sold a business or a property and just looking for a shorter duration option to consider. So, very simple, not a lot of complexity to the strategy or the pay schedule. And again, no risk of that sixth premium. So various markets you can think of, business owners who may be close to or exiting their business, late 50s, perhaps mid 40s, cash on hand, looking for a short duration, not interested in longer pay schedules. Other markets we've seen are grandparents and where they're looking to transfer intergenerationally amongst their family, and ideally do it on a shorter schedule, as they might not be around to pay premiums over a 20-year or beyond, for example. So I just wanted to highlight the opportunity using our 5Pay as well. This is just our insured retirement strategy concept report that's built into our software, which you can run, pretty much any scenario on using any of our par products. And of course, the opportunity with IRP is to position life insurance as not only a benefit with respect to the life need, but of course the opportunity for tax deferred growth and the opportunity to access income in the future. And got a little case study here. Quick example for a 45-year-old male non-smoker, recently sold his business. He's got pretty substantial liquid assets, looking to deploy them, wanting to invest, and considering allocating about a third of the portfolio into a par policy. So, really simple example, $1 million. And currently this client invests in non-registered investments and some limited RSP room, likely given former business owner, dividends don't generate RSP room. So what my goal is here is just to share kind of where the opportunity is with 5Pay. So if we look at this particular example, we're taking the $1 million and we're taking the same cumulative amount. We're going to invest across, or evaluate different pay schedules to see kind of how they perform over the long term for this client. So in this case, we're investing, 5 years, 5Pay schedule, real simple, $200,000 over that period. So not referenced here, but the initial death benefit on the policy is just close to $2.7 million. That will never drop. That will obviously continue to grow as the dividends come in. But if we look at an income opportunity at age 65 for this 45-year-old male, we're able to generate $87,000 a year, just close to that, from age 65 to 85. And that's about $1.7 million in tax-free income. Net estate value at age 90 after repayment of the loan, net estate value would be $3.4 million. So if we look at that same scenario and run it over a 10 pay, saying, okay, we're going to take the same cumulative $1 million, but we're going to look at a 10 pay schedule. We're going to invest that $100,000 per year. What do we get? Now, very similar initial death benefit, 2.7 million. Income on this example from age 65 to 85 would be about $7,000 less at 8,000 a year over the same 20-year schedule. About 1.6 million in cumulative income. In net estate value at age 90 would be 3.1. So essentially, with a 5 pay, same dollars invested, we would be able to provide about $7,000 more per year in annual income and about $300,000 more in net death benefit, everything else being equal. So if we look at the 20 pay example, 20 pay scenario, again, same situation. We've got $1 million cumulatively going into the policy, 50,000 a year over the 20-year period. What does this look like? How does this compare to a 5 pay? We can see, income is significantly lower, just about 69,000 a year over that same 20-year window. And age 90 death benefit is significantly lower than the 5 pay, about 25% lower at 2.6 million at age 90. So just, emphasizing the opportunity of investing early, getting that policy paid up, and obviously the compounding effect of investing those premiums earlier on versus stretching them out over a longer term period. So what fits in really well to the 5 pay is our new concept I wanted to share. We just launched this a few weeks back, which is called the Generational Legacy Plan. Pretty unique. I haven't seen a similar concept in the market. And it's the 5 pay can fit in well, but you can run directly on our illustration software with any par product. The goal of the Generational Legacy Plan is just to really educate clients and provide them with an understanding of how life insurance can work with respect to them passing on wealth to their children or grandchildren. And of course, the tax opportunity that's available in life insurance, which is not there for non-registered investments. So it's a longer report. I've just put in a few slides here in a case example, but we recently had a very large case settled where this concept was used, and a grandparent who had sold their business for a significant sum of money was looking to invest for both their adult children and their grandchildren. So, we were able to get a case approved for $5 million on the grandchild and using a 5 pay policy. So, great opportunity out there to use this and concept and maybe go back to some of your existing clients and talk about some of that wealth, some of those higher income individuals, some of those clients who may have, sold a business or sold some real estate, and just talk about, transferring wealth to the next generation. So, great opportunity. But, essentially it's quite simple. The idea is obviously to, purchase a par policy, whatever schedule you like. You can illustrate on our software. And what the report is designed to do is to show that compared to a traditional investment, par is more efficient, especially on the transfer of ownership. So I screenshotted here. This is what the data entry page looks like on our quote software. We can run a number of different scenarios. Just for simplicity, I specifically said we're going to grandfather is going to be the owner, and we're going to have the grandchild. So that's going to a policy is going to transfer at some point in the future, which we can set up the software and customize to show when. Directly from grandparent to a grandchild. Our tool will also allow you to run a scenario where it would go grandparent to adult child, and again a subsequent transfer to the grandchild as well. So that's one of those scenario drop downs that are available to you. And then I've specified that we're going to transfer this policy 15 years in. So in this case, I've actually used an adult grandchild who's 24 years old, female. She may not be financially mature at this particular stage, and granddad is interested in retaining control, but at some point in the future is likely going to transfer ownership. Now, many of these cases, these clients are going to have money invested already. It's likely going to be at a bank. In this case, I've illustrated a GIC over here on the left. So 100% of the comparative investment is in a fixed income, GIC generating 5% a year. Obviously, that's taxable. That would generate a T5 once a year. There'd be taxes due on that income, and of course, with PAR, we've got tax deferred opportunity. Now, if that client was already invested in a mutual fund or perhaps in stocks, we could change that taxable investment allocation. Design it with whatever rate of return we wanted. Build out the current split of that portfolio and show them a great example of the power of kind of the life insurance over the short term and the long term, and emphasize that tax-free rollover to the new owner. So here's just a screenshot of some of the inputs. So in this example, I've highlighted $8,000 a year going into a 5-pay, relatively straightforward 5% comparison on a taxable investment. And you'll see the output of the report here. Going to jump along, basically just runs that transfer scenario based on the year we've selected and says, what does that taxable amount look like on the GIC? So up top, we can see there is no tax to be paid on transferring that policy to the adult child at age 39. On the bottom, of course, the GIC, there is tax that needs to be paid. And that would be the case on a mutual fund, on a GIC, pretty much on any non-registered investment. So highlights the opportunity. The report also, mentions, how this is possible, right? And the subsections of the CRA Tax Act are quoted here. I just highlighted them, but this is all built into the report. There's some, key benefit slides talking about locking in insurability, transferring wealth, and lots of great information. So great report you can share with clients that's pretty detailed. Now, if we were illustrating a different scenario where we were going grandparent to adult child onto grandchild, it would show two taxable events happening on the traditional investment, taxable investment, which would obviously erode the returns. A quick table here, just highlighting the investment schedule, $8,000 going into that PAR policy over a 5-year on a 5-pay solution, and that same $8,000 on the right going into the taxable investment strategy. Now, you dictate when that policy is going to be transferred. So this is a conversation that you can have with your client. In this case, we've ran a scenario at 15 years in. We're going to look at transferring that policy when the female is now 39 years old, grandpa's 77. So this is entirely flexible. You can select that and run multiple scenarios if you like. But it highlights sort of where the cash values, total cash values are with respect to the PAR policy, and where that GIC rate or where that portfolio is at, given the client's tax rate, and given the rate of return we've entered onto the software. Now, obviously, with any of these plans, we're doing their long term, right? We want to also highlight not just the 3-year or the 5-year or 12-year cash value and death benefit. We want to look at longer term. If we were running a 10-pay, we could illustrate our wealth solution and highlight some earlier cash values. But my view here is that we really want to look long term and see how this investment performs for this young lady, down the line. So we can see, I've just highlighted a couple ages here at age 50. You can see total cash value is well ahead of the portfolio value. In both cases here, we've got very low risk investments. I would argue 5% GIC is probably hard to get over the long term, but we've used a pretty generous rate of return in this example. We could choose whatever rate we wanted. But of course, over the longer term, that policy continues to build steam. We've got some significant growth that we can really highlight and focus in on with our client, where the GIC is basically half in terms of portfolio value versus total cash value at age 65, and similarly some significant growth over the long term. So if those of you are familiar with a estate bond concept, it's a very similar strategy. We're essentially running the investment comparison to a par policy and looking at the long term. But the emphasis here is on that transfer, that opportunity to transfer that policy when and if that policy owner chooses to their, again, adult child or grandchild. They may change their mind. It may not go to the adult child. It may go directly grandparent to grandchild. That year can change, but I think a key benefit is being able to retain control without a negative, tax liability when that policy is eventually transferred over. So new concept. I think it's just a good opportunity to go back to some of those clients who've already purchased par, have already done some great planning with you, and just have that conversation about the next generation and kind of what the plan is, and particularly for clients who have higher incomes, higher cash flow, and liquid assets on hand, they may be willing to look at a pretty significant size policy on their grandchild. And of course, we have less underwriting concerns the younger they are. Just a lot of benefits in terms of growth and continuous growth within the policy. Anyway, just wanted to pass that on. I don't know if we've got any questions in the chat, but if there are, I'll just stop sharing my screen here and jump back to the.
All right. Well, thanks very much, Aris. It was great to see you again.